If you are a veteran and someone has told you that your credit score is not high enough for a VA loan, I want you to stop for a moment before you accept that as the final truth. A lot of VA loan denials related to credit are not happening because a veteran truly doesn't qualify. They're happening because VA guidelines are misunderstood, oversimplified, or replaced with lenders' internal rules, aka overlays. That difference matters more than veterans realize. So here's the first question you should ask yourself. Was I denied on actual VA guidelines, or was I denied based on a lender overlay? Those are not the same thing. Knowing the difference is often the key to home ownership. Today, I am going to walk you through the VA loan requirements, the way underwriting actually evaluates them, not the internet version, not the big bank version, and not the quick no version you get from call centers. We are going to be talking about credit scores, why you actually have three of them, and why mortgage lenders use the middle score. What VA underwriting truly cares about: collections, charge-offs, and late payments are really reviewed. I'm Cathy Sabater, mortgage broker and VA loan specialist. This video is about helping you understand what actually matters so you don't damage your credit or disqualify yourself before you ever should. Section 1. The three scores. Let's start with something that causes a massive amount of confusion. You do not have one credit score. You have three. That is because there are three credit bureaus. And they are Experian, Equifax, and TransUnion. Each bureau can show different information because not every creditor reports to all three. Balances updates at different times, and disputes can appear on one report but not the others. Here's a scenario. App versus lender. Here's a very common scenario. A veteran checks a credit app. They see a 670 score. They feel confident. They apply for a mortgage, and sometimes they might be shocked when the lender says the score being used is 635. So naturally, you're thinking, how can I have a 670 but they're using 635? Well, the reason the lender pulled all three bureaus and the other two were lower, mortgage lenders do not use your highest score. They do not use your lowest score. They use the middle score. Let me make it a little clearer. If your scores are in TransUnion 610, Equifax is 635, and Experian is at 670, the score being used for your loan is going to be 635. The 670 doesn't help you. The 610 doesn't hurt you. It is the middle score. That is the one that actually drives the decision. Here's a question you have to ask yourself. When you check your credit, did you know which bureau you were looking at? Did anyone clearly explain that mortgage lenders use the middle score? If no one explained that, then you're actually looking at the score that matters. Section 2. The myth. The single biggest myth in VA and VA lending in the loans is that VA, it does not publish a minimum credit score requirement. I want to repeat that again because this is quite important. There is no VA handbook, any rule that says 620, 620. There is no VA handbook rule that says 640. There is no VA handbook rule that says 660. Those numbers usually come from the lenders. They are called overlays. What is an overlay? An overlay is a rule a lender chooses to add on top of the VA guidelines to reduce their own risk or to simplify their underwriting. Here comes a scenario. Lender A versus lender B. Here is how this plays out. A veteran applies with lender A. Lender A has a policy. We only approve VA loans with a 640 score or higher. This particular veteran has a 630. They are denied. They assume that they are not VA eligible. That same veteran applies with lender B. Lender B does not have that overlay that allows the VA guidelines to take precedence. That is why that veteran is now approved. And they're approved with the exact same credit profile. Nothing changed except the lender's overlay. Was I denied by the VA or was I denied by company policy? Because VA underwriting is not just score-based. It is risk-based. Your credit score is just a quick snapshot. Underwriting evaluates behavior. Section 3, the 5 questions. Question 1, payment history. What does my recent payment history look like? VA cares about the last 12 to 24 months. Here comes a scenario. You had a late payment during a divorce 2 years ago, but for the last 24 months, everything is paid on time. That looks like recovery. Now compare that to someone who had perfect credit for years, but missed payments last month. Underwriting looks at recent behavior. Ask yourself, does my recent history show recovery or ongoing struggle? Question 2, your housing history. What does my housing history show? The best predictor of whether you will pay a mortgage is whether you have paid your rent. Scenario, veteran A has decent credit score, but paid rent late 3 times last year. Veteran B has a slightly lower score, but has perfect rent history for 3 years. Veteran B can be viewed as the safer borrower. Again, ask yourself, have I been managing my housing payment responsibly? Here comes question number 3. Residual income. Do I have strong residual income? Residual income is one of the most powerful things that the VA concept has, and most people don't know that it exists. Residual income is what is left over after your new mortgage payment, installment payments such like your cars, your student loans, minimum credit card payments, and this is unique to VA, utilities and taxes. Let me give you another scenario for this. Veteran A qualifies on paper, but only has $200 left each month after bills. Veteran B has a lower credit score, but has $1,200 left over each month after bills. VA prefers stable breathing room. Another question to ask yourself. After paying my bills, do I still have breathing room? Question 4. Patterns. Is there a pattern of issues or was it isolated? VA looks for patterns. Here's a scenario. 2 missed payments during PCS because a payroll error or mail delay, then cleaned afterwards. That is isolated and explainable. Missing a payment every few months randomly, that is a pattern. Ask yourself, was my issue a one-time situation or a repeated pattern? Question number 5. Credit moves. Am I making credit moves right now that could backfire? Timing matters. Here's a scenario. A friend tells you pay off all your collections 2 weeks before applying. You do it. The account updates. Your score drops. Your middle score falls under a lender overlay, and now your loan is delayed. Same credit, different timing, different outcome. Ask yourself, if I make this move right now, could it hurt me short term? If you are seriously considering buying or selling, in order to buy, this is where you stop guessing. Before you pay collections off, before you pay off disputes, before you assume you need 6 months of credit repair. Okay? Here goes section number 4. Collections. Now let's get specific about the bad stuff. First, collections. Now the VA does not require all collections to be paid, especially medical collections. Here comes a scenario. A veteran has medical collections from a surgery 3 years ago. They assume they can't buy until all of it is paid off. That is often incorrect. Yes, you heard me. Incorrect. However, non-medical collections are different. Scenario, a bunch of recent consumer collections. And that's from last year's cell phone bill, maybe your credit cards. Utilities can signal current stress. Underwriting cares about context, right? How many, how recent, total balance, and whether the behavior is ongoing. Question. Are my collections from a resolved period in the past, or are they happening right now? Next is charge-offs. Charge-offs sound scary, but they are not always automatic VA denial. Here's another scenario. A charge-off from 4 years ago during unemployment, and since then, rent and auto are clean. That shows recovery. But charge-offs from 6 months ago with no reestablished credit, what would that be? Well, that's very different. That provides a different profile, right? Because that shows a pattern. Question to yourself. Does my credit show recovery after the charge-off? Late payments. Finally. Late payments. This is where VA gets stricter because if they are recent, housing lates matter, auto lates matter, and repeated 30 days late in the last 12 months are a red flag. I know you like these scenarios, so here it comes. A late during PCS with clean payments since and a strong explanation. That's workable. Multiple recent lates with no explanation other than I forgot. That is tough. Question. Are my late payments explained and corrected, or are they ongoing? Section 5. Manual underwriting. This leads to one of the most important tools in VA lending. Now, automated underwriting versus manual underwriting. Some VA loans are run through the AUS and they give us computer findings. But now some files can be handled through manual underwriting with compensating factors, similar to the scenario we talked about in regards to lower credit score but higher residual income and strong housing history. Let me give you another scenario. Lender A says the computer said no. Another lender says VA and documents the strengths properly. Now, instead of a computer reviewing it, we have to go the extra step and we get a human underwriter to review it. It has some different requirements, but now it takes a little more time. However, it is not a denial, right? Now the loan gets approved. Same borrower, just a different approach, different outcome. And in this case, experience definitely matters. In conclusion, here is the takeaway. VA credit approval is not just the score. It is about recent behavior, housing history, residual income, patterns, and timing. If you were told no, don't assume it's final. If you are seriously considering buying or selling to buy, let's connect before you make credit changes that can cost you months. I'm Cathy Sabater, VA mortgage specialist. Please leave your comment or questions. And the biggest mistake that VA veterans can make is disqualifying themselves before they ever should.